Hello, welcome to FIN 1003, Financial Systems in Canada. The topic for this video is just a quick review of some of the calculations that we did in class on October 31st, 2018. So a quick reminder, that was week 9, and so we were studying chapter 7 from the textbook, and the focus was on the stocks and the stock market, okay? So I'm not going to review all the slides in the video. You've got them on Blackboard. I'm just going to click through until we get to some of the calculations. Again, we should always be familiar with what the course learning outcomes are. So there's course learning outcome 1, course learning outcome 2, course learning outcome 3, and now we're really focusing on course learning outcome 4, which is explaining the valuation model of the stock market and the efficient market hypothesis. Actually, we're going to go beyond illustrating how stocks are valued, and we're going to do some of the calculations, okay? Again, a quick review. Governments and companies issue debt securities to borrow money, and they often in the form of bonds, and they need to pay interest in the principal on maturity. Now we're looking into equity securities, different words meaning the same thing: shares, equity securities, stocks. This is when a company issues equity securities. They're giving up ownership in the company, and the investor is buying the shares to participate in the ownership of the company. A quick review: debt versus equity in terms of the priority claims. Common stockholders are residual owners. So assets equals liabilities plus equity. Assets minus liabilities equals equity. So if a company was to go to bankrupt, they would sell all the assets, pay all the liabilities, and what's left over is the equity, which is goes to the owners of the company. This is an old slide. Again, not going to talk through it, but again, we've seen this in my Core Portfolio Management 101 presentation. It's just telling you that stocks, long-term on average, have had the highest capital return, annual return, but also the highest standard deviation of returns. That's a measurement that we use for risk. So there's a trade-off between risk and return. The higher return, the higher the risk, or the higher the volatility. Standard deviation of returns being the square root of variance, okay? A little bit of introduction of why stock valuation is done. Basically, investors that are active portfolio managers are going to try to find mispriced securities. So they're going to calculate the intrinsic value of a stock, what they believe the stock value to be. And if the stock is undervalued, they're going to buy it with the belief that eventually the market will catch up and the stock price will move towards its intrinsic value. So a quick practice question here. An analyst estimates the intrinsic value of a stock to be in the range of 17.85 to 21.45 euros. The current market price of the stock is 24.35, so this stock is most likely A, overvalued, B, undervalued, or C, fairly valued. Well, the answer is A. The current price of the stock exceeds the upper bound of the analyst's estimates, so the stock is overvalued. This slide is just talking about estimated and value and market price. The price of a financial asset is often determined using a present value of future cash flows approach, and that's exactly what we did. Recall when we calculated the price of a bond. The price of the bond is the present value of the future cash flows using a market interest rate to discount the cash flows back, okay? I just wanted to remind you that the CFA Institute Investment Foundations chapters are all free, and so if you're not familiar with stocks and bonds, again, going back to review the bonds, chapter 9 on debt securities is excellent. It's only 26 pages. So just a quick reminder, in that CFA Institute Investment Foundations program, chapter 9 on debt securities, we had the valuation of fixed rate and zero coupon bonds. We can see here that for fixed rate bonds, the value is just the present value of the future cash flows, okay? And so it went through an example, and we've done this in class before. I just want to remind you that the value of the bond is the present value of the cash flows. So this one, consider a 3-year fixed rate bond with a par value of 1,000, coupon rate of 6%, and it's paid semi-annually. So 6% would be $60 a year. Semi-annually would be every 6 months, so the coupon would be $30. So we can see that the value of the bond is the present value of the cash flows. Okay, in the first case, they're using a discount rate of 7%. That's how we're going to calculate the price of a bond. It's being sold at a discount here. because 7% is higher than 6%. Okay, so that was just a quick review on the bond valuation using different discount rates. So skipping ahead a couple of slides now, we're looking at the one-period valuation model for stocks. And in the one-period valuation model, we can see P0, the current price of the stock, equals the dividend paid at the end of year one, plus the sale price of the stock at the end of the first period. And we're discounting back here by the required return on an investment in equity, which, if we used, that could be different rates depending on the country and the risk and the timing. But, if we looked at historical returns on the S&P 500, we might say that could be around 10%. Okay, so this is just a present value calculation. We're discounting back for one period, so this would, you could put a 1 right here. But remember, present value equals future value or cash flow divided by 1 plus R, or to the N. Okay, so this is a one-period valuation model. So N is going to equal 1, so we don't put the 1 there. Okay, and instead of R, which is our discount rate or interest rate, we looked at using R when we're doing the price of the bonds. We're now using a nomenclature of KE, which is the required return on investment in equity. But don't get confused by the algebra and the nomenclature. It's just saying to calculate the P0, and for the bonds we saw that was V0, so you see sometimes different nomenclatures. It's just the present value of the future cash flows, and these cash flows, because it's a one-period valuation model, are just coming 1 period later. So the quick practice question, which was straight out of the textbook, using the one-period valuation model, assuming year-end dividend of 11 cents, an expected sales price of $110, and a required rate of return of 10%, the current price of the stock would be A, $110.11, B, $121.12, C, $100.10, or D, $100.11. Okay, the correct answer is C. So let's just write that out. P0 is going to be D1, which is 11 cents, and we're dividing by 1 plus the cost of equity, which is 1 plus 0.10 to the power of 1. And then it's plus the sale price, which is $110, and we're going to divide that. We're going to discount that by the same rate, 10%. So P0, that's writing it out in full, would just be $110.11 divided by 1.1. Okay, so if I just bring up the calculator, okay, we've got the calculator, so it's 110.11. That's $110, and the 11-cent dividend that's coming at the end of the period 1 divided by 1.1, just a present value calculation. And again, we've got $100.10, so the correct answer is C. Okay, I think that's a pretty easy question. I think the one-period valuation model is very easy. It's just the present value of the future cash flows, and the future cash flows is a dividend and selling the stock at $110. So $110 you'll receive for selling stock plus 11-cent dividend, discounting it back at 10% for 1 period. So we just divide by 1.1. Very easy. So moving on from the one-period dividend discount model, we're looking at a generalized dividend valuation model. And it's saying the value of the stock today is the present value of all future cash flows. So again, that's why I wanted to show you back looking at the bonds. This is a very similar, same formula for the bond calculation. It's just saying that the value of the stock today is the present value of all future cash flows. Okay, so again, the numerator is the dividends, and at the end of the day, we've got PN. That's when you're going to sell the stock. Again, continuing the comparison to the bond, PN, that would be the face value of the bond when you get your principal back, and the dividends would be the interest. So again, if you know how to calculate the price of a bond, the theory behind it, then you know the generalized dividend valuation model is very similar. It's the value of the stock today is the present value of all future cash flows. Again, I highly recommend, if you're new to finance and you're new to the concept of stocks and bonds, then the CFA Institute Investment Foundations program, which is free, and all the chapters are free to download. Chapter 10 is on equity securities, and it's 26 pages, and it's a great little introduction with regards to stocks. Page 16 of the chapter on bonds, which was chapter 9, had the example of the valuation. And similarly, in chapter 10 here on equity securities, example 6 on page 16 of the chapter is showing the discounted cash flow approach. So it's showing you, working you through the example of an investor expects Volkswagen, a German company, to generate a dividend of 4 euros per share at the end of 2012, 4.20 per share at the end of 2013, 4.50 per share at the end of 2014. Furthermore, the investor estimates that the stock price of Volkswagen will trade at 150 euros at the end of 2014. So they walk you through the valuation for this. So you can see the value is simply the dividends, a 4 euro dividend, 4.20 dividend, 4.50 euro dividend at the end of 3 years, and at the end of 3 years selling the stock for 150 euros. And so we're just discounting them back. We're doing the present value after year 1 of the 4 euro dividend, the present value of the 4.20 euro dividend after 2 years, 4.50 after 3 years, and selling the stock after 3 years. And we're using a discount rate of, considering all risks, concludes that using a discount rate of 14% is appropriate. So you just you add up the present value of the dividends and the stock selling price, and you get an estimated stock value of 111 euros and 2 cents. I had a student ask me, can you do that on the financial calculator? And indeed you can. So just let me bring up the calculator, and we can do it using the cash flow functionality here. So the cash flow at time 0 would be 0, because we want to calculate the stock price. And also I want to clear anything that I've got in there. So I'm going to do second, clear work. And if I go through, yes, I should be at all zeros in terms of the cash flow functionality. Anyhow, cash flow 0 is 0. At the end of year 1, we have a 4 euro dividend. So we hit 4 and we enter. We arrow down. This is frequency. It's only one dividend once. So we arrow down. Cash flow 2 is 4.20 euros. So we're going to enter 4.20. We're going to hit enter, arrow down. Frequency is only 1. And cash flow 3, we're going to add the two together. It's 150 and 450. So I'm going to do it as 154.5. I'm going to hit enter, and the frequency on that is only 1. Okay. So then what I'm going to do is I'm going to click on this button that says NPV, and I need to enter the interest rate. And we can see here we're using an interest rate of 14%. So I'm just going to hit 14. I'm going to hit enter. Then I'm going to arrow down, and when it says here NPV, I'm going to hit compute, and I'm getting 111.02363. So you can see 111.02. So I haven't had to do all the individual present value calculations and then add them up. I used the CF functionality on the Texas Instruments BA2 Plus. Okay, so again, the estimated stock value, or the intrinsic value, using this analyst's estimate of what this price selling the stock at 150 euros at the end of 3 years, plus the estimated dividends, estimated stock value 111 euros and 0.02, and it's simply the present value of the future cash flows. Again, in my slides, I had another example, present value models, the dividend discount model. So for the next 3 years, the annual dividends of a stock are expected to be 2 euros, 2 euros and 10, and 2 euros and 20. The stock price is expected to be 20 euros at the end of 3 years. If the required rate of return on the shares is 10%, what is the estimated value of a share? So the present, so we're just, the value, the V naught, is just the sum of the present value of all the future cash flows, okay? So again, I can bring up my financial calculator, and we'll just, do it once, do it twice. It's good practice. Just let me bring it up and clear it here. So we've got, we're going to use the cash flow functionality again. Second, clear work. Just check that's going to delete all the any entries you've made previously again. So I'm just going to show you. You hit cash flow, and then second, clear work, and that clears the calculator. So cash flow, there's at time 0, there's nothing, because again, this dividend is coming at the end of 1 year. So we click arrow down. Cash flow 1 is the 2 euro dividend. Enter it. Frequency 1. Cash flow 2 is 2 euros 0.1. Going to enter that. Frequency on that one is only 1. So the cash flow 3, we're going to add the 2 together. It's going to be 22.2. 22 euros 0.2. We're going to enter that. Then, as I said, we're going to click on the NPV. The required rate of return is 10%. So we're going to hit 10, enter, arrow down, NPV. That's what we want for our stock price. We're going to hit compute, 20.232, 20.23. Yes, so that's how we can do it. We can use the algebra to calculate the present value of each. There's the algebra, calculating the present value of each of the dividends plus the expected stock price at the end of 3 years. Add up the present values, or we can use the cash flow functionality on the calculator. Okay, moving on now in our stock market stock valuation. We're looking at the Gordon growth model. And this is important to look at this model in terms of the assumptions. And one of the assumptions to use this model is that dividends are assumed to be continuing to grow at a constant rate forever. So if we look at the formula, P naught equals D1, that's the dividend in the next period, divided by the required return on an investment in equity minus this G. And the G is the expected constant growth rate in dividends, okay? So we're not going to cover it today, but as you increase your studying of finance, there are some formulas that we use to calculate the cost of equity. One is called the CAPM model, and the CAPM model is saying the required return on equity equals the risk-free rate plus the beta of a stock, which we haven't studied yet, times the return to market minus the risk-free rate, and the return to the market is the equity risk premium, okay? But let's not get into that today, but I just want to let you know, and you probably will see it at some point in your future studies, that the required return on investment in equity, we can calculate what that is based on the CAPM model, and it relates to the risk-free rate, which is a T-bill rate often, or a government bond rate, and adding that to the beta times the return to the market minus the risk-free rate, which is the equity market premium, okay? Now, in terms of the G as well, there's ways to calculate it. G equals the retention rate on dividends. We have a payout rate on dividends, and we have retention rate times by ROE, which is return on investment, okay? But again, we're not going to get into that. But higher up in finance, we get into a lot of sub-calculations where we need to calculate the cost of equity and the G. But leave it for now. P naught equals D1 over K minus G, okay? D1, the dividend in the next period. KE, required return on investment in equity. And G is the expected constant growth rate in dividends. So just a quick practice question to check our understanding on the Gordon growth model. The Beasley Corporation has just paid a dividend of $1.75 per share. If the required rate of return is 12.3%, and dividends are expected to grow indefinitely at a constant rate, so you see the word constant rate there, you know which model you can use, of 9.2% per year, the intrinsic value of Beasley Corporation stock is closest to A, $15.54, B, $56.45, or C, $61.65. Okay, the correct answer is C. So recall the formula P naught equals D1. In this case, R minus G, different nomenclature, or KE minus G is talking about the same thing. So it says just paid a dividend of $1.75. So that would be the dividend now, D naught, okay? We need D1. So D1 is D naught times 1 plus G, and we know that the growth rate is 9.2%, so D1 is going to be the $1.75 times 1.092. So I'm just going to bring up the calculator, $1.75 times 1.092, that's the 1 plus G, so we got 1.911, and that's why it's important to run more than, I like to use 5 decimals on my calculator, because you're going to get into certain roundings, and I want the numerator to have, 1.911, okay? So D1 is 1.911, and we're going to divide by K minus G, or R minus G, and the required rate is 12.3%, and the growth rate is 9.2%, but of course we're going to use it in decimals, 0.123 minus 0.092, So again, just bring up the calculator, and maybe I'll just slide the calculator over. Okay, slide the calculator over here, and so for the denominator, it's going to be 0.123 minus 0.092, which is the 12.3% minus the 9.2%, and we get 0.031. 0.031. So just bring up the calculator to finish the calculation. Numerator 1.911, that's D1, divided by 0.031, which is K minus G, and we got 61.645, so that is closest to C, 61.65. Okay, so that is the calculation of a stock price using the Gordon growth model or the constant growth model. Okay, just going to finish this video to remind you that for Chapter 7, and we didn't cover all the theory on the expectations, etc. in this video. I just want to focus on the calculations. Anyhow, we've did some multiple choice questions in class. They're posted to the Blackboard straight out from the publisher's question bank. So you can see a few multiple choice questions on the theory. Stockholders' rights include A, it's the right to vote. No, it's not the right to manage. Stockholders aren't necessarily managing a company. If I can own shares of TD, I'm not working for TD. They don't have a primary claims on all cash flows. We know that stockholders have residual claims. Assets minus liabilities equals equity. Sell all the assets, pay all the debts. What's left over belongs to the stockholders. And no, has nothing to do with ownership of bonds. Okay, so some theory questions. And then there's some nice one-period valuation model questions. Scrolling down more, there's some Gordon growth model questions. You can see here, let's just do one very quickly. Gordon growth model D1, they're giving you the D1 is $1, cost of equity 10%, and G is 5%. So what is the current stock price? Well, we know P naught equals D1 over K minus G. So if I brought up the calculator, just let's move it into the right position. Okay, the D1 is $1 divided by K minus G. K is 10% and G is 5%, so it's just $1 divided by 0.05, 5%, and we'd have $20. So the correct answer was B. So you can see that using the Gordon growth model, when they're giving you the numerator, the denominator is only one calculation that you have to do, K minus G, and then a subcalculation, and then the calculation is just D1 divided by K minus G. It's very easy. Okay. Scrolling down here, though, I like this question here, number 29. It says, what is the current price of a utilities company stock? If the current dividend is 20 cents, the expected constant growth rate in dividends is 2%, required return is 8%. So we know P naught equals D1 over K minus G. K minus G is 8% minus 2%, so that's 6%. But we don't have our D1. We've got our current dividend is 20 cents, and it's going to grow at a constant rate of 2%. So we need to calculate our D1. So let's just bring up the calculator again. And so our current dividend is 20 cents, 0.2, and it's going to grow by 2% times 1.02. And again, you can see this is a good reason why I want to have more than 2 decimals on my calculator, because the answer is 0.204, and we need that rounding, okay? So that's our D1. D1 equals D naught times 1 plus G. D naught, our current dividend was 20 cents. We grew it by 1 plus G, 1 plus 2%. So 20 cents times 1.02 gave us 0.204. Divide by K minus G, just a quick look. Our K is 8%, G is 2%, so we're just going to divide by 0.06, and we've got the right answer, D, $3.40. Okay, so that's it for this video. That was just a quick review of stock valuation using the one-period model, the constant growth model, and that's it. So thank you very much.